Welcome to The Explainer. Today, we're unpacking the ultimate financial paradox hidden inside AVAV's latest metrics. If you're the kind of person who loves digging into the numbers to make sense of contrasting realities, well, you are absolutely in the right place.
114.16%. That is AVAV's top-line revenue growth over the trailing 12 months. I mean, explosive is honestly an understatement here. For a company to more than double its revenue in just a single year, that's the kind of metric that usually sends investors into an absolute frenzy of buying. But then gravity hits. Negative 53.33%. Despite that massive, explosive revenue growth, AVV's stock is currently sitting more than 53% below its 52-week high of $417.86. Okay, let's dive into this. Part 1. The AVAV paradox, growth versus gravity. Starting with top-line triumphs, the growth engine. At the very top of the income statement, AVAV looks like an absolute juggernaut. And this brilliantly illustrates exactly what we're talking about. AVAV's revenue compound annual growth rate is basically a runaway train right now. Over a 5-year period, they averaged a highly respectable 32.47% growth. Shrink that window to 3 years, and it accelerates to 48.75%. And then over the trailing 12 months, boom, that's staggering 114.16%. The growth rate isn't just high, it's accelerating incredibly fast. And you know, that accelerating growth isn't just some theoretical percentage either. Over the trailing 12 months, it translated to $1.61 billion in cold, hard revenue. That is a massive, undeniably huge footprint in their market. And for the folks who've believed in this growth engine for the long haul, they have been richly rewarded. If we zoom out a bit, the historical long-term numbers are just phenomenal. We're talking a 10-year return of over 563%. A 15-year return of roughly 569%, and a totally staggering 714% return over 20 years. That's the kind of long-term chart that makes index fund investors a little jealous. But getting to those massive long-term returns definitely comes with some severe whiplash. Historical volatility is completely standard here. Just look at the jump from a 109% surge back in 2017 straight down to a 28% drop in 2021. Then you see another surge of 57% in 2025, leading directly into the current year-to-date drop of 19.38%. Massive stomach-churning swings are just part of the DNA here. Which brings us to part 2, the bottom line bleed. Where did all the profits go? So you gotta ask yourself, how can a $1.6 billion juggernaut be struggling so deeply with its stock price? Well, here's the stark, sobering reality. AVV's trailing 12-month net income is negative $224.36 million. Let that sink in. While $1.6 billion is coming right in the front door, it's costing them way more than that to actually operate and grow the business. And because they are losing so much money, traditional valuation models just completely break down. Their PE ratio sits at negative 44.94. For those who might not look at this metric every day, a negative PE essentially means the company is currently losing money. There are simply no positive earnings to compare the stock price against right now. This bottom line bleed isn't just some isolated accounting quirk either. It's a systemic chasm. Trailing 12-month free cash flow is bleeding out to the tune of negative $246 million. Net profit margin, return on assets, return on equity, they are all deep, deep in the red. The company is burning through cash at a massive systemic level just to fund its growth. Let's move to and see how this builds into part 3, fortress balance sheet, the safety net. Now, normally, burning $250 million a year sparks instant bankruptcy whispers, right? Not here. They actually boast a current ratio of 5.51 and a quick ratio of 4.54. Basically, having over 5.5 times the liquid assets required to cover short-term debts buys management some serious, vital time. It's the massive cushion they absolutely need to fix the cash burn without facing an existential crisis tomorrow. To solidify that fortress balance sheet argument even further, check this out. Their debt-to-equity ratio sits at an incredibly low 0.17. This means the company is primarily funded by equity, not by debt. They are not suffocating under heavy interest payments. They actually have immense financial flexibility, even with those massive operational losses. Which leads us to part 4, valuation and verdict.
pricing the paradox.
Now, what's really interesting about this slide is how exactly investors price a paradox like this. Well, they pay a premium for the acceleration. The price-to-sales ratio is 6.03, meaning despite having literally zero earnings, investors are still paying roughly 6 times revenue just to own a piece of the growth. Meanwhile, the PEG ratio sits at just 0.10, which proves the market is hyper-focused on that top-line potential.
Ultimately, when we look at the data derived straight from the source, AVAV represents a pure clash of realities. On one hand, you have soaring 114% top-line revenue growth, securely backed by a fortress balance sheet with practically no debt. And yet, on the other hand, the gravity weighing down the stock price is that massive negative free cash flow and a total lack of net income. It's the ultimate push and pull.
Which leaves us with the ultimate question. When a fortress balance sheet provides the safety net, but negative cash flow represents the daily reality, which metric actually dictates the future? Does growth eventually yield profit, or does the cash burn eventually eat the fortress?